Hi, this is our second video in part 3 of our financial education series. And in this part, what we're focusing on is investing and just some basics of investing. In the first video, what we talked about is why we invest in the first place, and just how important it is to keep that in mind before you make the decision to take something out of your savings account and make it an investment. Being very upfront and very clear about the why, right? What I want to focus on in this video is some more of those basics. And what I want to focus on is time horizon and how important time horizon is to the investment choices you make. And then also just scratching the surface on some of the investment options available and tie it back to how we think about time horizon. Okay, so why is time horizon so important, and why am I starting with time horizon? The reason is because when I say time horizon, what I mean is the time, right? The time it takes between the moment you move funds from your savings to an investment vehicle, so investing in a stock or a mutual fund, to the time that you actually want to spend those funds, right? So if it's buying a house, and you're investing to eventually buy that house, if it's 5 years, then it's the time you move those funds into an investment for 5 years from now when you're actually going to want to spend that money. The reason the time horizon matters so much is because of those differences we talked about savings and investing in that last video, right? When we invest, we give up liquidity, right? We give up the ability to turn something to cash right away. We often give up accessibility, right? The ability to access funds tomorrow. And then we also take on risk in the value of the investments, right? Especially in the short term. I mean, historically, markets are volatile. They go up and down. And I gave the example last time that, $5,000 in a savings account, I expect it to be worth $5,000 on Friday, right? $5,000 that's invested in the stock market may not be worth $5,000 on Friday. It could be worth $4,000. It could be worth $6,000. And it's all going to be subject to the value of the underlying investments. So the time horizon matters so much because that's going to dictate your ability to put up with that fluctuation, to put up with that inaccessibility, to put up with that illiquidity. And the more of that risk of fluctuation and the more of those parameters that you're willing to put up with is often going to lead to the potential return that you can get from the investment, right? Because ultimately what you're getting paid for, right, with those investments is to take on that risk, right? You take on the risk of the underlying company, take on the risk of the underlying investment, take on the risk of that fluctuation and the ability to not access those funds for a given time period. So anytime you're making an investment, if you take nothing else away from this, anytime you make an investment, start with the time horizon. Understand what it is you're investing for and make sure that's helping you help you think through the decisions about the amount of risk you take on and the type of investment you're making. Okay, so with that in mind, let's talk about the difference between a stock and a bond. Because I think this is just a great place to start in thinking about time horizon and investments in general. So when you purchase a stock, what you're doing is you're investing money in a company in return for a share of that company. So basically in return for ownership of that company. So, as a stockholder, what you have is equity in the company. So the value of your stock is going to depend on the growth of that company, the ability of that company to pay dividends, the ability, the likelihood that you may be able to sell that share of that company in future years. A bond, on the other hand, is a loan. Think of it, when you purchase a bond, what you're doing is you're loaning money to a company or most often the government, right? U.S. Treasuries, the most common bonds, right? You're loaning money to the government in return for them paying you interest on that loan. The risk you're taking on with a stock, right, when you make that investment, is you're taking on the risk that the value of that company. With a bond, you're taking on the risk of the likelihood of whoever you loan that money to, whether that's the federal government or your corporate bond, a company, of the ability to repay that investment. right? And when you look at stock market or bond market fluctuations, they reflect that, right? As the companies that are riskier have more volatility. The stock price may be cheaper, but the potential returns may be greater. And bonds, similarly, the likelihood that company can pay back the loan is going to affect how valuable that bond is, right? A company that maybe is not as likely may be willing to pay a higher interest rate in order, if you're willing to take a bet on them. So I talk about those two things because I think people sometimes lose sight of what they're actually purchasing when they're purchasing a mutual fund, a group of stocks, or a bond, a mutual fund that holds bonds, a group of bonds. Forgetting that at the underlying, what is beneath all that is an investment in a company or a loan to a company or a loan to a government if we're talking about treasuries. That ties back to time horizon because your willingness to take on the risk of the purchase of those companies, right? Those underlying stocks, or you're willing to take on the risks of loaning to a government or to a corporation. Depends on how much time you have and how much you can put up with over the term of the investment before you want to use those funds that you're investing, that you're moving from savings to investing, before you want to use them.